So there's a new diamond jewelry brand hitting the market with an IPO, and it's backed by a legacy that's nearly 2 centuries old. Today, we're going to break down the PNGS Reva diamond jewelry IPO to answer one simple question. Is this a glittering opportunity or is it a high-stakes gamble? Right, this is the big question for any investor looking at this. Over the next few minutes, we're going to give you the full picture, the good, the bad, and the risky, so you can decide for yourself. Okay, first things first, who exactly is PNG's Reva? Now, the company itself might be new, but it carries the name and the trust of a 190-year-old legacy in the jewelry business. That's a huge head start. PNG's Reva's whole game is premium jewelry. We're talking diamonds, precious stones, platinum, stuff that starts at around the 20,000 rupee mark. But here's the key thing you need to know. They don't actually make the jewelry. Their entire business is focused on design and sales, which lets them lean heavily on that powerful 190-year legacy of their promoter, PN Gadgil Sons, to build instant trust with customers. Now, that laser focus on design and sales is powered by a very, very clever business model. Let's take a look at the engine that's been driving their really impressive profitability so far. It's something called the shop-in-shop model, and it's pretty much exactly what it sounds like. Imagine you walk into a big, trusted PN Gadgil store, and right there inside, there's a small, dedicated Reva counter. They get all the foot traffic and trust of the big store without having to build one themselves. And the power of this strategy is, well, it's incredibly clear. 33 of their 34 outlets work exactly this way. This model just slashes huge expenses like rent and setup costs, creating a super efficient asset-light operation that's been, wildly successful for them. And here's the proof in the pudding, a return on equity of over 34% last year. To put that in simple terms, for every 100 rupees of shareholder money they had, the business turned out about 34 rupees in profit. That is just remarkably efficient. With that kind of performance, you can see the appeal, right? So let's really dig into the bull case, the argument for why you should invest, and what their plan is for future growth. First off, that top line is looking strong. Their revenue jumped in just 1 year from 1980 crores to 258 crores. That is a really healthy sign that people are buying what they're selling. But it's not just about getting bigger. It's about profitable growth. With operating margins hitting over 30%, the company is keeping a really healthy chunk of that revenue as actual profit. That speaks volumes about how well their current model works. So what's the big plan for the 380 crores they want to raise from this IPO? Well, the vast majority, 286 crores, is going towards opening 15 new exclusive brand stores. And that is a major shift in strategy. Another 35 crores is set aside for a big marketing push to build up their own standalone brand. But, and this is a big but, that shift in strategy is also where all the risk is hiding. You can't make a good decision without looking at the potential downsides. So let's unpack the bear case. Okay, this one is huge. A staggering 97% of their revenue comes from just one state, Maharashtra. Think about that. If that single market slows down for any reason, a local economic issue, anything, the entire business could take a massive hit. That is a huge concentration risk. And when you dig into the financials, you find a few things that make you go, They're sitting on 33 crores of inventory. That's a lot of jewelry that isn't turning into cash quickly. Even more telling, their operating cash flow was negative in the first half of this year. That means while they're booking profits on paper, the business is actually spending more cash than it's bringing in. That's a classic red flag. And this really gets to the heart of the risk, doesn't it? The company is basically pivoting away from its proven, low-cost shop-in-shop model to an unproven, high-cost exclusive store model. Their old method was all about efficiency. The new one comes with much, much higher costs and a ton of uncertainty. So what we have is a proven, really profitable past versus a risky, ambitious future. How does all of this translate into the IPO's price tag? Let's talk valuation. At the top end of the price range, PNGS Reva is being valued at a price-to-earnings ratio of 30. Now, if you look at their competitors, that's just a little cheaper than Senco at 33, but it's double the valuation of PBG at 15. So it's not the cheapest on the block, but it's not the most expensive either. It's kind of in the middle. And here's the crucial takeaway on that price. The valuation feels a bit steep for how small the company is right now. The price you'd be paying isn't really for the company as it exists today, but for the company it hopes to become If those 15 new stores are a massive success, you're paying for the promise of future growth. So it really all boils down to this. The bull case is a bet on a few things: that the demand for premium jewelry will keep growing, that you trust that 190-year legacy, and that you have confidence they can pull off this risky expansion. The bear case is a worry about that extreme focus on one region, the negative cash flow, and the huge costs of changing their whole business model. So the final decision really is yours. Is the power of that incredible legacy and the promise of big growth enough to outweigh the very real risks of concentration and expansion? That is the calculated gamble that's on the table.